Possibly my favorite write-up of the year. Get ready for a monster reversion trade for the ages. Hey everybody, Luke Downey here with mapsignals.com. We have an awesome piece here looking at some data. It was actually shared on Forbes, so I'm super excited about it. Let's get to it now. So what is a reversion trade? Well, a reversion trade is basically when one area of the market is acting a certain way. Right now, a lot of stocks are getting sold, and then they revert back to the mean. So they basically can have this huge lift off. That's what we are expecting based on data. But let's go ahead and look at what is going on all around the market. Now, you may be wondering that, hey, a couple of stocks are going up, but a lot of my stocks are not going up. Well, there's a big reason for that. And if you look at the big money index, it shows this beautifully. Here we've got a chart of the S&P 500, right? This is the SPY ETF. It's in blue. Notice that it's going higher, right? But also we can look at the big money index is actually going lower, right? Now, what is that telling you? This is telling you that there are more stocks that are getting sold, right? So volumes are increasing as the price is going down. So under the surface is not that healthy for the market. That is one thing that you need to realize is going on in this market. Another way to visualize this is looking at different baskets of the S&P 500. So here I've got a year-to-date chart, and we've got the S&P top 50. So if you take the top 50 stocks, right, the biggest stocks in the S&P 500, it's up almost 23% year-to-date. You compare that to the S&P 500 in the blue, which is up 15%. And then if you equal weight the S&P, right? So if you take all 500 stocks, you give them an equal weighting, it's literally only up 5% year to date. That is a drastic underperformance. And that kind of jives with what we're seeing with the BMI falling, right? Now, here's why this is so important to look at potential reversion trades. So I went and I pulled a really cool ratio chart where you take RSP, right? That's the equal weight S&P ETF. You divide it by SPY, that's the S&P 500 ETF, and you get this cool ratio. And here's what is interesting about it. The ratio, right, this black line has fallen to a level that we have not seen since the financial crisis of 2008, right? That's what this red line is telling you. Whenever this ratio declines of this magnitude, it's telling you that the average stock is not performing well under the surface. So relative to the big caps, the average stock is actually under a lot of pressure, okay? So this is just a relative ratio chart. We can also see that we had some areas of weakness of this ratio during the COVID crash. So basically, when the market is in these twisters, right, this uncomfortable area, we see this ratio start to plummet. Now, here's what is so cool about data, because this chart has been getting a lot of action. A lot of people are very fearful, right? They're seeing that a lot of stocks are breaking down. They're worried that this could spell potential disaster. But here is why you need to get ready for a monster reversion trade for the ages. So I went back and I took all of these periods and I looked when that ratio fell below 32% since 2007. So let's go back here. Here we're right around 30%. So I'm saying all of the periods where we're 32 or lower. So it's going to get some of this COVID area, definitely going to get the GFC, and it's going to get some periods that have happened recently. So check this out. Here are the forward returns when you look at all of these instances where we were below a 32% RSP SPY ratio. So 3 months later, the S&P 500 is up 2%. The equal weight is up 6.7. But what's even cooler is 6 months later, S&P is up 13%. The equal weight's up 24%. A year later, 29% gain the S&P 500 compared to a 47% face melter ripper in the equal weight. And then if you go out 2 years, I know people don't want to think about 2 years, but that's what you got to be thinking about if you want to make money in the market. 78% is your average return for the equal weight RSP ETF 2 years when this ratio is below 32%. Now, I should just call it quits and just say, hey, that's the study, but I'm going to do one more for you. Now, if we just signal out 31%, right, or below, so let's go back to this chart, 31%, that's going to be right here. You're really talking about the financial crisis, okay? That is the last time we got below this 31%. If you are allergic to green, I would have you look away right now. Here are the forward returns when the RSP SPY ratio is below 31% since 2007. 6 months later, the equal weight ETF is up 29.7%. 12 months later, it's up 57%. Now, notice the S&P 500 is still up, but it's this differential, this spread. This is that reversion that I'm telling you about. 2 years later, 24 months later, the RSP is up 92%, so almost a double compared to a really nice 57% average gain in the S&P 500. So this is that reversion, right? This is the juice that we're talking about. There's a lot of unloved stocks out there. It's the best time in history to be a stock picker. That's what we told you. I'm telling you, you are going to start to see some stocks that are going to do some things that you really wouldn't believe. So if you're just focused on NVIDIA, if you're just focused on the super micro computers, we believe you're probably missing some of the biggest low-hanging fruit out there. Make sure you have a map to follow these market moves. Make sure to like and subscribe to this YouTube channel, and I will see you next time.